Hello class, welcome to chapter 12 lecture video. Okay, this is the last chapter for this unit. Okay, before your next exam you got coming up. I'm exactly halfway through the class now. For the second unit here so far, we have talked about some basic costing terms and decision making. Okay, we learned contribution margin and how to find a break-even point and operating leverage and stuff like that in chapter 7. Chapter 8, we learned some operational decision making. Okay, now we're going to get to chapter 12 and we're going to start talking about capital decision making. So let me get my screen shared here and we'll get going. Oh, no, not that. Capital investment decisions. So what is a capital investment decision? Okay, now capital investment decision, basically what we're talking about here is wherever we're buying something for like a long-term investment. We're investing in some property, plant, and equipment. Maybe we're investing in some computer infrastructure. Okay, but it's something that we are going to capitalize when we make the payment. Okay, so we're not going to expense it right away. That's why it's called a capital. So we're going to capitalize it and make it an asset. And we are going to use it for a long period of time in order to generate revenue. Okay, so there's two types we're going to talk about here. Okay, there's independent projects. Okay, and those we just look at by themselves. Okay, if we do this project, it is not going to affect anything else. It's independent of itself. Okay. Mutually exclusive projects, on the other hand, is basically a this or that decision. If we choose A, we cannot do B. If we choose B, we cannot do A. Okay, that is what a mutually exclusive project means. Okay, so when we're making capital decisions, what we want to do is we want to make sure that we're going to get our money back at least, and then we're going to make some kind of profit, a desired rate of return on the initial investment. 10%, 15%, whatever the company sets. Okay. So there's some, in order to know if we're making a good capital investment decision, some of the things we need to know. We need to know what kind of cash flows we expect to generate from this decision. Okay. Not only the amount, but the timing of them. Okay. Because we're going to start to, if we start talking over long periods of time, 5, 10, 15 years. Okay. There's a concept called the time value of money with compounding interest, which is what we're going to talk about a lot at the end of this chapter, which basically means that $1, if I have $1 today, it's worth more to me than if you were to give me $1 a year from now. Okay, because I could take that money, put it in the bank, and of course, it would gain interest. Okay, so that's why the quantity, the amount, and the timing of the cash flows are important. How risky is the investment? And then how is this going to affect our firm? Okay, even think back when we talked about in chapter 8, some of those qualitative factors, okay, kind of political pressure. What's it going to do to our reputation, stuff like this, maybe if we decide to take on this project. So when we go to make these decisions, as I said, there's two types of decisions, the independent and mutually exclusive. There's also basically two broad categories of models that we're going to use to decide whether we should accept or reject this capital investment. I mean, first is non-discounting. Kind of recall back just a few minutes ago, I was talking about that time value of money stuff, how having $1 today is worth more than having $1 tomorrow. Well, there is a way to take that $1 tomorrow and discount it back. Okay, so say if you gave me $1 today, I could have $1.03 at the end of the year because I'm getting 3% interest. Okay, so if I wanted to sell you something for $1, but you said I'm not going to pay you for a year, okay, well, we'll say, okay, well, now it's going to cost you $1.03. Okay, because I want to recover that interest. Okay, that $1.03 that I'm going to receive in a year from now is worth $1 today. That $1 is what it is discounted to. Okay, those are the discounting models. It's taking into effect that time value of money. Okay, and they seem to be a lot more accurate, and they're better to use when you're making the decisions because, you know, compound interest, especially when you're talking millions and billions of dollars with some of these major corporations, that compounding interest is a big, big deal. Okay, so our first non-discounting method is called the payback period. What the payback period essentially is, simply is how long is it going to take us to pay back our initial investment? Okay, this is very good for highly technological fields where stuff is becoming obsolete real quick. So if you're going to invest in something technological, you want to make sure that it's going to generate enough cash flows immediately to pay for itself real quick before that newest technology comes out, okay, and something comes better. Okay, so that's that impact of liquidity, obsolescence, and performance measures, okay? Those are some of the things we can assess. It is calculated like this. If cash flows are even, it's really, really easy to calculate. It's just the original investment divided by the annual cash flows. So if we invested $400,000 and we expect to get $100,000 back each year, it's going to take us 4 years to pay it back. However, if they are unequal, then we just need to kind of keep track, figure out where we actually cross that payback period at. Okay, and whether we're doing even or uneven cash flows, whatever our cash flows for the year is, we're always going to assume that it's collected evenly throughout the year. So if we end up in the middle of 2 years recovering that investment, okay, we can just do some simple division, as you'll see through the example. It'll make it make more sense just to find out what that fraction is. Okay, so here's our example. Suppose we require an investment here of $100,000 and either has A, even cash flows of 50,000 or B, the following expected cash flows. Calculate the payback period. All right, so if we had 50,000 cash flows per year and we invested $100,000 per year, how long is it going to take us to pay it back? 2 years. Okay, it's that easy. It's the original investment divided by the cash flows. Second part here. When we don't have regular cash flows, we look at it like this. In year 1, we had $100,000. We got 30,000. So in year 2, we still got to recover 70,000. And we got 40,000 that year. Okay. In year 3, that means we still have to recover $30,000 of our original investment. The cash flows for that year were $50,000. So somewhere in year 3, we hit that $30,000 threshold. Okay, so it took at least 2 years and part of that 3rd year. Okay, since we only had 30,000 to collect, 50,000, okay, was a total that we collected that year. We assume that it's evenly. So you take your 30,000 divided by your 50,000. Okay, and that's how much of the year we're going to assume it takes to collect that $30,000 in cash in order to recover that initial investment. So our answer here would be 2.6 years. Okay, so usually a company, if they're going to use this method, they are going to, you know, say we are going to have a payback period of 2 years, 3 years, 5 years. Okay, as you see some of the stuff here on these slides are giving some helpful information. I'm not going to talk about a lot of it. You can go back and look through it, but there are some limitations that come back there. Okay, the 2 major deficiencies. It doesn't worry about the cash after the payback period. Okay, so yeah, that's great that we paid that initial investment off. We got to pay it off in a year. What's it doing in years 2 and 3? Okay, and it ignores the time value of money. Yes, it might take us 4 years to pay it off, but those dollars we're receiving in year 3 are not the same dollars that we spent in year 1 because of the time value of money concept. Okay, so our second method here is called the accounting rate of return, the Pirates way to figure out if we should do it the Pirates way, because they say R, right? Measures the return on a project in terms of income. Okay, so this time, we're not really worried about the timing of the cash flows, we're more worried about income. Okay? What's good for this? It's great for debt covenants. Debt covenants are contracts that you sign when you issue debt, whether you're borrowing from a bank or you're issuing bonds as a corporation. Okay? Sometimes they're in there that if certain ratios or certain financial analysis of your income compared to your assets, all this stuff, if it doesn't add up to something that they want, they can make that debt callable immediately where you have to pay it off. Okay, so if you're measuring a capital project, okay, you want to make sure that your accounting rate of return is good, so you're not violating a debt covenant. Okay, it is not going to maybe make your assets so high that without increasing your income enough, that now you don't have those correct ratios in there. Okay, so how do you find the accounting rate of return? It is average income divided by your initial investment. Okay, average income, if its income is the same every year, it's really easy to find because that is the number. If it's 100,000 every year for 5 years, your average income is 5 or 100,000. If it lists out all the years, you just add them together and divide by the number of years. So here we have an initial outlay of $100,000, a 5-year life, no salvage value. The yearly cash flows are 50, 50, 60, 50, 70. Calculate the net income for each of the 5 years. What you have to make sure you do on this, since we're using net income and it is giving us cash flow, you have to subtract out the depreciation expense because we're worried about net income now. Okay, it didn't say straight line. We're assuming if it gives you a question like this that it is doing straight line depreciation. So the $100,000 no salvage divided by 5 years, 20,000 a year. So you take your cash flows to get your net income. So now when we find our net income, we're using these numbers here on the far right when we're finding our average net income. You add those up, it's 180,000, divide by 5, get you 36,000, divided by the original investment of 106,000, get you 0.36 or a 36% accounting rate of return. And then again, you would compare this to whatever your corporation, whatever your boss has set, what kind of goal are we looking for? What do we need to hold? What does this number need to be if we accept or reject this project? So this does consider the profitability of a company. It looks beyond the payback. So it's might be considered a little bit payback, a little bit better than the payback period method. But what it still does not do is take into account the time value of money. Okay, it is again one of those non-discounting methods. Okay, so it does have some limitations in that fact. Okay, especially when you're talking about a project that could span 15 to 20 years. Okay. So let's get into our discounting models. Okay, these are, to me, these are the fun ones. They're really practical that you can use in real life. If I had you in person in class, we would take more time and we would actually talk more about present value and what you can do with present value. Okay, but in this shortened time, we're going to get through the basics of it and hopefully you're going to understand present value. But before we get into that, if you are watching this video right now, after you get done and before the next test, I want you to send me an email. I want you to put the word bonus into the category line and then just, as in the body of the email, right? I watched the video. I'm going to give you 5 bonus points. And I do this as an experiment to see who watches the video and who's actually paying attention or who just kind of skims through it to find what they need. Okay. So as I said, put bonus in the subject line and just wrote, I watched the video and I will give you 5 bonus points. You got to have that to me by the end of the next test. So if you do it by Sunday night, you'll be good to go. All right. So the discounting models. First is going to be the net present value. Okay. Here is our nice, great, big mathematical formula for net present value. The good thing is we are not going to have to use that formula. In your textbooks, I don't know what page it is, it gives you charts, okay? What we're going to be doing is we're going to be finding the present value. It doesn't have really slides that explain this real well, so yeah, we'll go back to this one, okay? When we're finding present value, what we're going to do is we're going to need a cash flow. Okay, that's the CF. Okay, that is how much money we are going to receive at some point in the future. We have an I. Okay, what kind of interest does the company require? Okay, that is going to be set by the company. They're going to say this is our required rate of return. T, the time period. When is this happening? When are we getting the cash flow? 1 year from now? 2 years from now? 3 years from now? Okay. And then P, the present value. What is that future cash flow worth today? So there is a way to figure that out using an algebraic formula. Okay, we are going to use charts for it instead. Okay, the P, now I'll write it. I hope you watch the videos with the examples on these, because the examples are going to make it step it through a lot easier. The P is going to be the present value. Okay, the present value is going to equal the cash flow, or the future value, what we get in the future, multiplied by our discount factor. Okay, we are going to get our discount factor from charts. Okay, there's going to be charts in your textbooks. When you do the homework questions, there's going to be charts on the page. It's going to say click on this for the chart. Okay, and it is going to give you a decimal number. Okay, that is your discount factor. Okay, well, it's not actually going to give you a decimal number, it's going to give you a chart. On that chart, you will find the interest rate and the time period, which are given. It could be 12% interest in 6 years. You will use that chart to match up to your decimal number, and that's what you will use. So your present value will be your future value multiplied by your discount factor, which is found with your interest and your time period. Okay. So kind of talk about this on here. Required rate of return must be defined. It's also known, you might hear referred to as the discount rate. Okay. How do we use this net present value? So didn't even kind of give you a great example how we're going to go through it. What we're going to go through, we have to find the present value of every single cash flow that we expect. Okay, so we have to find the present value of year 1 cash flow, the present value of year 2 cash flow, the present value of year 3 cash flow. We add them all together, okay, and then we subtract out the initial investment. And that gives us a number. If that number is greater than 0, if it is a positive number, then we say that's a good project. We accept it. Okay, we are making above the desired rate of return. If we are exactly at 0, that means we are making the rate of return that we're using in these calculations. Okay, if we get an answer of 0, that means that we are making, and we use 12%, that means that this project will make the company exactly 12%. It's hitting it right on the money. Okay, if it's a negative number, it means it is not reaching the required rate of return, so you would reject that project. So let's kind of see how it's going to work out here. Okay, a detailed market study revealed annual revenues of $300,000 for new earphones. Equipment will cost $320. equipment can be sold for 40,000. All right. So in addition, the working capital is expected to increase by $40,000 because of inventories and receivables. We recover the investment in working capital at the end of the project's life. Do we have cash and operating expenses? Okay. What are our annual cash flows? That's the first thing we need to know. Okay, step one, we're doing net present value. We need to find out what cash flows are we going to have each year. So in our first year, we have an outflow of $320,000 we pay for the equipment. Okay. Here we have our working capital. That said that 40,000 that comes from working capital is expected to increase by $40,000. Yeah, that means we need to take $40,000 of cash and we need to put it into inventory and receivables. Okay. So basically our total investment here is $360,000. For years 1 through 4, okay, we're going to receive a total of $120,000 in cash flows because it tells us our revenues are going to be $300,000 each year with operating expenses of $180,000. In year 5, we have revenues of $300,000 and the expenses of $180,000 still, but we get the salvage value. We receive that at the end of year 5 when we sell the equipment, and then we get that $40,000 back in working capital. Okay. So there's total cash flows of $200,000 each year. So we need to find the present values of all these numbers. Excuse me. Okay, so in year 1, our cash flow is $360,000. We do not have to discount it at all. It is at its present value. That is today. Okay, so it stays out there as going out as $360,000. So in year 2, well, years 1, 2, 3, and 4, we calculated the cash flows to be $120,000 per year. So 120, 120, 120, 120. So here we would multiply this by our discount factor. Okay, so how do we find our discount factor? Okay, we have a required rate of return of 12%. Our time period here is 5 years. Okay, I don't have a copy. I wish I would have brought a copy so I can have it up to the screen of the chart. But you would look at your present value chart. Okay. And you would go down and you would say, okay, here's my I. My I is 12%. Okay, my N or my periods, my time, 5 years. 12%, 5 years. Okay, I followed across. And that's where I get my 12% 5-year factor. For year 4, I go at 12% 4 years, and it would give me that number. 12% 3 years would give me that number. 12% 2 years. And then when you multiply them all out, and once you have everything over here, that is when you add them all together. Okay, all these added up minus the 360 initial investment. Get you a net present value here of 117,968. And if you recall, a positive net present value means accept the project. All right. Our next one is called ER. A little bit different than the R. You know, this one is the internal rate of return. Okay, what the internal rate of return, what we're basically doing here is we're saying, what interest rate do we need to get to make the net present value 0? Okay, so basically it's telling you what kind of return you're getting on your investment internally. Okay, the internal rate of return, what your project is generating internally should be higher than your required rate of return. Okay, so like in the net present value, it's saying we need to make 12%. And we went out and found the net present value, and the net present value had to be above zero. With internal rate of return, we know we need to make 12%, but we're finding the internal rate of return. Okay, that's what makes net present value zero. So if we found internal rate of return is 12, we wanted 12%. Both of those are showing a zero net present value. It's kind of how they're kind of tied together. Okay, but your internal rate of return should be higher than your required rate of return. I almost lost my sayings there. You have this nice equation here. Okay, you do not have to use this equation, which is the great thing. Okay, this is kind of a trial or error type of thing. If you were doing this in real life, you'd really need a good business financial calculator, which I left mine in my office. I didn't bring it down here. Okay, or you need computer software to calculate this when there's uneven cash flows. Because we're looking at cash flows here, and computers and software, they're going to run through and they just have to throw percents into the equations that we were using for net present value to find out what makes it work. Okay. Computers, software program, our little smart calculators can do this really, really quick. Okay. So we're not gonna have to calculate any of those, but if the internal rate of return, okay, if cash flows are uniform, meaning they are the same every period as it is in our question here, you can find the internal rate of return like this. Okay, you take your initial investment divided by your annual cash flow. Okay, and remember, you can only do this when they're the same. When you get that number here, okay, we took the investment of 205,570 divided by 50,000, we got 4.11141. Okay, we would have to go to our chart. Okay, we have to pull out our chart here, and we'd have to look. We'd have to go at 6 years, because that's our time period here, and we'd scroll across there until we found the number that was closest to 4.1114. Okay, so as we're scrolling across, then we find it, and then we go up, we say, oh, okay, that's the percent. Okay, and that is how you would calculate internal rate of return. Okay, so most of these we've been talking about multiple projects. Okay, mutually exclusive projects, you want to run both tests on both. Okay, if there's a difference between the two, net present value is your go-to test. Okay, it gives you more in real dollar terms what you're doing. Okay, whereas the internal rate of return is kind of giving you, I wish I could. Oh man, I just lost the word that was in my head. Having trouble speaking today. But anyway, so the NPV, yeah, assumes that you invest it at the required rate of return, where the IRR assumes that it is invested at the computed rate of return. Okay, so if you're having a project that has a great rate of return, it's going to assume that once you get money returned from it, you're investing it at that same great rate, okay, instead of your required rate. So it's a little more inflated, the IRR is. Okay, so really when you're looking between mutually exclusive projects, you have to do a net present value analysis and IRR analysis on both of them. Look at the NPV first, take the one that has the highest net present value, and the internal rate of return just kind of confirms your decision. Okay, so that's enough for the lecture. Please watch the homework videos too. We're going to go through a couple questions where I'll have the chart with me next time, and we'll show you how it works. And we'll get this present value stuff down. I'll talk to you again soon. Thanks for listening.